Hi, everybody. Let's continue our thoughts on the overview of the equity section of an entity. Um, One of the things you look for when you look at the corporation's balance sheet is the information on the stock. And on the balance sheet and in the notes, here's some of the things that we'll look for about the number of shares of stock of the corporation. Okay. First is the number of shares authorized. That is the number of shares that the corporate charter, which is the legal document that controls the organization of the corporation, uh, says that it's allowed to issue. You could be any wild number you could think of. You may be a small business and say, I'm going to issue 1,000,000 shares. Well, you may just actually issue 1,000 shares to you, but you're authorized by your corporate charter to issue, 1,000,000 shares. Authorized is the number of shares that you've actually issued. Uh, the issued shares, okay, let me correct this. The issued is the number of shares that are in the hands of the public. So why would they be an issue between the authorized and the number of issued shares? Well, we mentioned earlier that the corporation buys shares back. So they may have issued, they may have, let's say they have 1,000,000 shares that are authorized in the corporate charter, and uh, they've authorized the 1,000,000 shares. They've actually issued 500,000 shares, but only 100,000 shares are currently in the hands of the public. The difference between the number of issued shares and the ones that are outstanding, that 400,000 share difference is treasury stock. That means this corporation has bought those shares back and they haven't been canceled. So the corporation still has those 400,000 shares that they can resell, hopefully at a gain. And then they've also haven't gotten anywhere close to their legal authorized number of shares, that 1,000,000 shares that they can issue. And should they get close to that number of authorized shares, they can go back and get shareholder permission, stockholder permission to uh, increase that number. And they have to change their corporate charter, but they have to get permissions from the shareholders to legally do that. Some other miscellaneous concepts, okay, dividends. Okay, uh, dividends are payments to the corporate owners, to the shareholders. The corporation can pay to you anything that the corporation owns. It could be stock in a subsidiary. It could be its own stock, which is a stock dividend. Most of the time, we just want cash. So most of the time, your dividends are going to be cash. But they're payments to the owners, to the shareholders, uh, anything that the corporation has in which to distribute to the owners of the corporation. Okay, a stock split versus a reverse stock split. Uh, Sometimes the price of a stock gets a little too high and the corporation decides we'll split it, either 2-for-1 or 3-for-1 or more. Several years ago, Coca-Cola and Pepsi were about the same share price, or give or take around $100 a share. Uh, as I recall, Coca-Cola split and Pepsi did not. So right now, Coca-Cola is roughly around half the price of Pepsi. But that's one reason that you might do a stock split. Your total, for you, the shareholder, the total ownership interest hasn't changed. It's just the number of shares have changed. Would you rather have one share of $100 stock or 2 shares of $50 stock. Well, the corporations that split the stock hope that if the share price gets a little bit more affordable, that more people will buy and it will help increase the price of the stock. One of the things you'll see occasionally is a reverse stock split. I don't recall your book mentioning this, but sometimes they'll do it in reverse. For example, the New York Stock Exchange has a minimum price on shares that it will list on the New York Stock Exchange. Let's say your stock has a bad run and it falls below the minimum price that the exchange wants your shares to be in. So what do? We do a reverse stock split. So you might end up having a 1 share of a $10 stock instead of 5 shares of a $2 stock. We do a reverse stock split to boost the price. Hopefully that'll boost the price of the stock, and it will not only keep it on the exchange, but maybe interest some institutional investors who won't buy stocks that are too cheap, otherwise known as penny stocks. Miscellaneous, let's see what else. The book mentions about the owner's equity for various entities. Okay, what you call it depends on what the type of the entity is. If you are a sole proprietor, just one owner, that's you, the equity section would have owner's equity. But that's you. That's the owner's equity. If you're a partnership with 2 or more people, the equity would say partner's equity. The partner's equities are calculated the very same way that we do the owner's equity. It's just with multiple owners. We call them partners' equity. We know corporations, the owners are called stockholders or called share owners, and the stockholders' equity section represents the interest of the owners, the shareholders. And for a nonprofit organization, there are no shareholders. There are no owners of a nonprofit organization. So the equity section is just called a fund balance, and they may have different types of funds, but it represents the equity interest that is there for the nonprofit organization, and they would show balances like for more often than not, it'll just be a general fund balance, and that shows that keeps the balance sheet in balance, and it shows the accumulated earnings of the nonprofit organization. Well, that is part 2, and I hope that helped. Thanks for listening.